The Volkswagen Group are officially in the red. They just lost about $1.5 billion US. In fact, net cash flow in the automotive division fell by nearly 2 billion euros in spite of them selling more cars. That's 47% below the previous year. Hello, my friends. Welcome to the channel. I'm Sam Evans. You're watching the Electric Viking. And the Volkswagen Group, largely because of Porsche, are in a bit of trouble here. In fact, they could be in more trouble than what it appears. The car group is incurring losses of around $1.5 billion US, more than 1 billion euros, primarily due to Porsche. Furthermore, the success of the group's brands with electric vehicles does have a downside. And finally, it is really strange that the automotive industry have not been reporting on this. What are they saying by a downside? What do they mean by the downside to the Volkswagen Group's EV success? I mean, Volkswagen as a group, their EV sales this year have gone mental. They're up by like 100%. Why is this a negative? Well, finally, the media are catching on to what I've been saying now for 4 years. Volkswagen reported an operating loss of $1.3 billion US for the third quarter of 2025. In the same period of the previous year, the group recorded a profit of $2.8 billion. At that time, I said, you probably recall this, the group was on a knife edge, that the trend of their profits declining and shrinking meant they could very, very easily slip into the red, which they've now done. The group's net income after taxes also turned negative, falling to a loss of 1.1 billion euros compared to a profit of 1.6 billion euros in the third quarter of 2024. Can the Volkswagen Group recover from this? Well, probably not. The sharp drop in earnings is primarily due to one-off charges totaling approximately 7.5 billion euros. But there's going to be lots more one-off charges coming, I can tell you that now. According to the company statement, these charges were mainly attributable to US import tariffs, the realignment of Porsche's strategy, and write-downs on goodwill, whatever that means. Without these one-off effects, they say, the operating margin would have been a respectable 5.4%. Ultimately, it amounted to just 2.3% across the group for the first 9 months. But here's the thing. Operating margins are they're not going up. I mean, no one is doing better than last year in terms of their margins. Operating margins are squeezing across the entire industry. Yeah, I mean, it's not going to change. It's only going to continue in that direction. Volkswagen confirmed its forecast for 2025, but added a caveat due to the supply crisis surrounding the manufacturer Nexperia. The forecast is based on the assumption of sufficient semiconductor availability, the statement reads. And that's a whole problem unto itself. Sales between January and September rose slightly by 0.6% to 238.7 billion euros. Global vehicle sales increased by 1.8% to 6.6 million units, with declines in China down 2% and North America minus 11%, more than offset by growth in South America, Western Europe, and Eastern Europe. The thing is, though, Eastern Europe and South America are low margin markets. We're talking value cars in those areas. You're not going to be selling many Porsches or many high-end Audis or Bentleys or Lamborghinis or Porsche, or yeah, you get my point. You're not going to be selling a whole lot of those cars in those areas. You sell some, but not many. Porsche is making a loss of about 1 billion euros. The group's results were particularly impacted by them. The sports car manufacturer, once a profit guarantor within the group, reported a negative operating result of 200 million euros for the first 9 months. In the third quarter, Porsche plunged into the red with an operating loss of 966 million euros, or about 1.2 billion US dollars. The manufacturer is suffering from a drastic decline in sales in China and must revise its once ambitious electrification strategy. As a result, Porsche and the group as a whole have significantly lowered their forecast for 2025. In the first 9 months of this year, Porsche's operating profit plunged by 99%. 99% plunge in operating profit is a pretty big problem. Despite record deliveries in the United States for the first 9 months of the year, Porsche's operating profit plummeted from over €4 billion or 4.6 billion US dollars in 2025 to a mere 40 million this time around. So it's a massive difference. The company blamed the massive drop on a variety of factors, including their product realignment strategy, challenging market conditions in China, which are not going to get any better, and one-off effects relating to battery activities. It shut down its battery factory or its battery development site in Europe. Tariffs also played a role, and they say they'll cost the company around 700 million euros or 814 million this year alone. The situation for the Volkswagen Group remains tense in the Chinese market, which is particularly important for the Volkswagen Group. Although sales declined only slightly, the market environment has deteriorated further. The aggressive price war triggered by massive discounts from Chinese manufacturers like BYD is putting immense pressure on German automakers, and that pressure is only increasing. Volkswagen CFO Arno Antlitz sees a mixed picture. He said while the company has been successful with both combustion engine and electric models, particularly in Europe, this very success with electric cars is proving detrimental, at least in the short term. Antlitz points this out in the press release, stating that the results are also being impacted by the ramp up of lower margin electric vehicles. So Volkswagen is saying to its dealerships, and it said this, I think, a few months ago, the amount we pay you on sales, the margins for electric cars, it's a lot lower than the margins for internal combustion cars. So if you walk into a Volkswagen Group dealer, they're going to want to sell you an internal combustion car because their margin on the EV is lower. And this is the problem. Volkswagen earns significantly less money on its electric cars than with combustion engine car vehicles. They won't tell us the truth on how much less it is, but I believe they're making a loss on average. Net cash flow in the automotive division for the entire Volkswagen Group fell to 1.8 billion euros in the first 9 months, 47% below the previous year. The group expects net cash flow of €0 for the full year. Zero. But net liquidity remains solid at around US 34 billion, so around 30 billion euros. But that could change very quickly. And remember, the Volkswagen Group as a whole, including its finance debt, has around $200 billion in debt. That's a lot of money. That's like a noose. Volkswagen continues to expect an operating return on sales of between 2 to 3% for the current fiscal year. 2 to 3%. If your operating return on sales is 2 to 3%, not 10% like what it used to be, then you're operating on a knife's edge. And it can be that easy to just slip off and fall.